Let's talk about why you should never buy rental property with a corporation. And I get it, right? Because having your company's name say incorporated sounds so much better than LLC. The name of my company is Stanberry Capital LLC. Wait, I got it. The name of my company is Stanberry Capital Incorporated. Yeah, so I understand why some real estate investors get hyped about having the letters Inc., Corp, and Corporation attached to their company's name. But here's the truth, okay? There are very few instances where it makes sense to actually put real estate rental property inside of a corporation instead of an LLC. And in this video, I'm going to explain why. So what I want to do is cover how managing rental properties are different with an LLC versus a corporation, the main events that trigger taxes on real estate, and then look at some math and calculations along the way. So if all that sounds good to you, then please just do me a little favor and click the like button for the YouTube algorithm so other real estate investors can find this video. Stay tuned. Hey there, and if you're new, welcome to our channel. I'm Sean with Life Accounting, the accounting company that helps you save on taxes and build more wealth. And as always, what I'm gonna do is put the timestamps for this video down in the description below so that you can skip to the parts that you want to learn the most about. But look, I think you will enjoy all the details that I have throughout this video. All right, let's go ahead and get started with number one, ownership and control of rental properties. So when you are planning to acquire your first or your next rental property, you have a few options for ownership and control, okay? You can acquire the property as an individual where you personally own and control the property, or you can acquire the property inside of an LLC or limited liability company, which has ownership of the real estate and the members actually control it. Or you could acquire the property inside of a corporation where the corporation has all the ownership and all of the control, and they give it up to the boards, the shareholders, and the managers of that corporation. Now, as a quick side note, there are other entities where you can acquire real estate properties, especially if you're looking to get others involved, such as different partnership structures, such as a general partnership, limited partnership, or even through a nonprofit corporation. Okay, so I use the words ownership and control to describe handling rental properties. And although they sound very similar, they're actually a little different. So let me quickly explain. So whichever entity owns the business asset, which in this case, of course, we're talking about the rental property, the entity that owns it is the one that is responsible for paying taxes on any income it produces. So for example, if you buy a property as an individual, then the flow could look something like this. Okay, let's say you had rental profits of $10,000, then that $10,000 would flow straight down to you as an individual, and you would pay taxes on that amount at the individual US tax rates. On the other hand, if you acquire real estate property inside of an LLC, then if you had $10,000 in real estate profits, then that will flow down to the LLC. But since the LLC is a pass-through entity, the income would still flow down to you as an individual for tax purposes, and once again be taxed at the individual US tax rate. Now, the reason why so many people love to put their properties inside of an LLC is because you get limited liability protection, which means that if someone sues you, then it will protect your personal assets, thus separating the LLC from you as an individual. But this is where control comes into play, because if the LLC owns the property, then the LLC members are the ones who control it, meaning that they make the decisions around the property, like what tenants to approve or what rents to charge or how to handle certain management decisions and so on. So it's very possible that you could be the owner of an LLC or really any business and lose control if you're bringing in other members or investors as a part of that business. Now, I have an entire video where I break down how to buy rental property with an LLC in 3 simple steps, which I'll link at the end of this video so you can check it out after you finish this one. But first, let's move on to number 2 and talk about managing rental properties within a corporation. So going back to our prior example, if you acquired real estate property within a C corporation, then the flow could look something like this, okay? Let's say you had rental profits of $10,000. Well, that will flow down to the corporation. And since the corporation is not a pass-through entity, it has its own corporate tax rate to determine how much taxes to pay on the profits, which is a flat 21% for the 2022 tax year, which means the corporation maintains control and ownership for tax purposes. And corporations still offer limited liability protection, which covers your personal assets in the event that someone tries to sue your corporation. Now, what most people don't know is that the process of buying and managing rental property inside of a corporation isn't really that different from managing it with an LLC. Probably the biggest inconvenience will be the extra reporting requirements and the strenuous tasks associated with maintaining and managing a corporation, such as appointing the right people, issuing stocks and shares, having regular shareholder meetings and recording meeting minutes, and so on. But after you get past all the maintenance that is required, then you'll hardly notice a difference in the day-to-day operations within your rental real estate business. However, even though the operations are very similar, the big problem is that the property is usually stuck inside of the corporation unless you're willing to face some significant tax consequences. Because the moment you begin to move property out of a corporation, it can trigger a taxable event. So let's go ahead and explore this a little bit further with number 3, tax consequences on real estate inside of a corporation. Now, acquiring property with a corporation is actually pretty easy, and there are usually no immediate tax consequences. So some real estate investors get things going, right? They get it set up, they get a tenant, they start getting some nice cash flow, and they think, oh, what was everyone so worried about? This is easy. Hey, wait, what's that? Because, okay, unfortunately, some investors and even some accountants lack the foresight to see future negative tax consequences associated with using a corporation when you have a real estate business, because you want to look at some tough questions like what happens when you sell the property, or how will you transfer the property for things like estate planning one day, or what happens if the partnership ends or your investors just aren't happy. So let's go ahead and start looking at the answers to some of these questions, starting with what happens once you sell the property within a corporation. So when you sell a rental property inside of a C corporation, then it triggers a taxable event where the corporation would need to pay a flat 21% tax rate on the gain of any appreciated real estate after the sale. For example, for simple hypothetical numbers, let's say you bought a property for $100,000 and then it appreciated to $300,000 and you sold it. Well, then you would have a gain of $200,000 and you would need to pay a flat 21% corporate tax rate. But remember, C corporations are not pass-through entities, so the profits must remain within the C corporation. And in order for you as an owner or shareholder to get the money out, you would have to take a distribution as dividend income, which will be taxed again on your individual tax return. And this is why so many people steer far, far away from C corporations, right? Like you have to pay taxes twice, one time at the corporate entity level and then again at the individual level. And this is also known as double taxation, and it can have huge tax inefficiencies for its owners and shareholders who are not aware of this. And so what some investors decide to do is they try to get slick and they decide to transfer real estate out of the corporation rather than sell it. But of course, the tax code covers this scenario too, because when you transfer a property, it also triggers a taxable event through a current distribution, which means it will be treated as if the corporation sold the property at fair market value. So basically, even if you transfer a property out of a corporation, it still will be taxed as a sale and subject to double taxation. And the same rules apply with an S corporation as well, except for the fact that S corporations are pass-through entities and they are not subject to double taxation. Although while an S corporation is not taxed twice, it still can't transfer a property without triggering a sale, which brings me to number 4, why use LLCs for rental properties? Using a limited liability company for your rental property business is a great way to protect your personal assets, get some flexible tax benefits, and start building up some business credit. And for those reasons, LLCs are usually the preferred entity of choice when it comes to acquiring property for the sole purposes of operating a real estate business. So let's look at the tax benefits of having an LLC. The first tax benefit is that when you sell any property, you are only taxed one time at the individual level, since LLCs are pass-through entities. The second tax benefit is that you can transfer property without triggering a sale like we saw with corporations, and that's because many people who own property in an LLC report gains and losses on their personal tax returns. And this makes the LLC a disregarded entity. So for example, if you transferred a property from your LLC to your personal name, then that would not trigger any taxes or be recognized as a sale, which allows you to then take back the property and have it in your own name. And if you decided to strategically, you could live in the property for 2 of the last 5 years, and that would entitle you to keep the profits from the sale of the home without paying any federal taxes on those profits. To be exact, you could exclude up to $250,000 in profits if you have a single filing status and $500,000 in profits if you have a married filing jointly status. Plus, there are many other tax benefits of owning a home, and I have an entire video where I list out each one. So what I'll do is I'll go ahead and link that video at the end of this one so you can check it out after you finish. So basically, you should understand that corporations, both S Corps and C Corps, make it very difficult to sell or transfer rental property without triggering a taxable event. But with an LLC, if you handle it properly, you can avoid triggering certain taxes. Now, I know I said you should never buy rental property with a corporation, but I do want to talk about number 5, 2 exceptions to using a corporation for real estate. I have 2 quick exceptions where it may make sense to have a corporation. Okay, 1, if you are an active real estate investor, and 2, if you are investing in real estate as a means for your business operations. Let me quickly explain both. So if you are an active real estate investor where you are maybe wholesaling or flipping or rehabbing properties, then these types of activities generate active income. And active income within an LLC is subject to self-employment taxes. And the key here is active, because most real estate investors are actually passive investors, so they don't need to worry about self-employment taxes. But active investors do. So they may benefit from setting up an S corporation. And that benefit of doing this is that they can pay themselves a reasonable salary on the portion of their income that is active from real estate. And then the rest of it would not be subject to a 15.3% self-employment tax. Instead, only the salary would be subject to the self-employment tax. So let me quickly explain with an example. If you acquire a property and you flip it for $160,000 profit, what you could do is pay yourself a reasonable salary of maybe $60,000 with an LLC taxed as an S corporation, and then the remaining $100,000 would not be subject to self-employment taxes. Whereas if you made $160,000 profit as a single member or multi-member LLC, then you would have to pay a 15.3% self-employment tax on that profit up to a certain amount. So that's one big exception for creating a corporation for real estate operations. The second big exception is if your primary business is something other than real estate, right? Like maybe you just want to acquire real estate for your business operations. In this case, you will be building up a company, so it's less important to worry about the tax consequences of transferring and selling real estate, and more important to build up a profitable company and leverage real estate to maybe do stuff like buy a retail store in a high traffic area to attract customers, acquire a manufacturing facility to produce and maintain quality products, or getting a long-term office space that is convenient for you and your employees. And in these instances, real estate is more so a supplement to building a bigger business asset for the long term. And this is articulated very well in one of my favorite movies of all time, The Founder, where McDonald's used real estate as a key to their business operations. And as you may know, McDonald's is set up as a corporation. Now look, I have to admit that all this is pretty complex and it should be thought about carefully, which is why so many people decide to work with my firm and book an appointment and book consultations to have an extra helping hand when it comes to making some of these very important types of decisions. So if you need help, then consider hiring our team by clicking the first link down in the description below to learn more about what we do and how we may be able to help you. But as always, I hope you enjoyed this video. Coming up next, I have 2 more videos that I mentioned. I will link at the end. One is all about the tax benefits of owning a home, and the other one is about how to buy rental property with an LLC. So if you haven't watched those yet, make sure you do, and I'll see you over there.